Saurabh Mukherjea, CEO Institutional Equities of Ambit Capital, is here with us to give us his view on where this sudden dose of power has come from. Hi Saurabh, good morning.
Morning.
We didn't see any FII buy figure yesterday. In fact, there was a sell figure. So perhaps a lot of local action in the market. But what's the sense you're getting about what took place yesterday?
I mean, hard to make sense of day-to-day movements, but I think, as you're saying, local investor appetite in the last couple of months has been very strong. I think there was a recent print that it's the first 3-month period in, I think, a long time, 4 or 5 years, when domestic flows have exceeded FII flows. So it's clear that the mutual fund community is seeing heavy inflows, plus retail investors are coming into the stock market, and that is but natural. You're a year into a fairly strong rally, and you're likely to see retail inflows pick up quite substantially this point in.
No, to be fair, DI money was actually positive yesterday, but it was a minor 84 crore. Saurabh, I know it's not possible to guess day-on-day movements, but you will be better at it than many others. Will you be worried that the market is moving without too much of fund buying and a whole 2% rally on an already well-bloated indices? Does it worry you that equally sharp corrections may come?
I think it's not so much the level of the index which is worrying me. What's worrying me is volatility is so low. So if you see the VIX, I think the Indian VIX is probably at one of its lowest levels I've seen it at for the last 5-6 years. And as we say in our profession, volatility is mean reverting. So if you have periods of very low volatility, it's almost inevitable that you'll revert to a period of higher volatility. I think that's probably what's causing us greater concern as to how abnormally calm the markets are. That's usually difficult to sustain. Something or the other will emerge to push the markets into a more volatile zone. It's but inevitable almost.
Is it also concerning you that we have not seen any resolution of some of the most trickiest problems that confront the Indian economy? Coal is still an issue, producers still lying idle because SEBs can't buy much. I mean, intractable problems, surely, but it's not. Now we are what, 4 months into the new government? That's not a small time.
Absolutely.
Does it worry you?
Absolutely. I think to be fair, I don't think anybody expected solutions just yet. But what I was expecting was the government to put on the table various options. So if you take, say, the Discom challenge, it's a challenge that we've been very familiar with in India for the best part of the last 20 years. We were expecting the new government to come with some ideas as to how this can be dealt with. So the fact that we have no public debate on either the Discom issue or, say, food inflation or the banking recap, the complete lack of discussion on these subjects is slightly perplexing. And if by, say, Christmas we are no wiser than we are today, I think we'll start losing a little bit of sleep about FY16 economic growth.
Okay, so would that lead to any volatility in the market? Because looks like the low-hanging fruit has now been picked out. How do you approach the setup from here on, and what could the markers be now?
I think if you look at the Indian market, the last couple of years, especially the last 12 months, have been about huge movements in the index, right? Not just the Nifty, but also rapid movements in the small and mid-cap index. As the new government sort of settles into office, as in a way people's normal service resumes in Indian politics, it's bound to become much more stock specific. So we still have upside at the index level over the next 6-7 months, but it's modest, 10-15%, I would say, at most at the index level. So you necessarily have to go back to stock picking and go back to our favorite theme, good and clean companies, high quality companies, well-run companies with clean management teams, clean accounts. And I think we will go back to stock picking, and there's plenty. The good news is there's plenty of small and mid-cap stocks which we think will have a good run in the remainder of the fiscal.
Okay, it's great you said that, because we wanted to get all the boring things out of the way and talk about the stocks. You came out with this report, Great Indian Mid-Caps, I think somewhere around May. And you've identified a lot of non-nifty good companies to invest into. Most of them have rallied significantly, whether it's Pidilite, whether it's Berger Paints, etc. But what are the fresh list of stocks that you're looking at now?
So I think the one big theme that we believe will do very well in the years to come, regardless of how our politicians perform, is what we call home improvement Indian style. So right from the bottom of the pyramid to the penthouses in South Bombay, Indians want to live better, and I think it's a very sort of almost primal desire to live in a better home. So what we are seeing in the last 4 or 5 years, and I think this will continue for at least another 5 years, is whether you look at paint, cement, electricals, sanitary ware, pipes, plyboard, the underlying volume movements in these sectors in terms of upward movements and volumes is intense. Just to put some numbers around it, there are, and as per the census, latest census, there's 120 million households in India without a roof over their heads, right? 120 million households. Now, blue-collar wage inflation, almost on every data premises, 15 to 20%. So even if you assume 2 to 3 million of these households get roofs over their heads, that's demand for plywood, for pipes, for paint, for cement, and hence I think this is a theme that we will look at quite intensely in the months to come. So just to highlight 3 specific plays around that we've liked for a while. V-Guard, the South Indian electricals company, which is making, I think, a fairly successful foray into northern India, into what one would call Havells territory. So V-Guard, well-run southern Indian company, initially strong in voltage stabilizers, but now a more full-fledged electricals franchise, making a successful foray into northern India. TTK Prestige, we've been highlighting it for I think 3-4 years, but I think it's got plenty of life left in it as the economy recovers, kitchenware spending comes back on stream.
But TTK Prestige, I mean, sorry to interrupt you. I've seen it as a child.
Yep.
I mean, is it not a spent area? Is it in the same area as home improvement?
So if we believe that everybody in India who needed a pressure cooker has one,
the replacement demand, yes.
So there is that
but
plus,
market expansion.
Plus, I think Lata, it's worth realizing that the majority of their sales are now no longer pressure cookers. That we have gone into other areas of kitchen electricals, and the kitchen as an area of spend has really come through in the last 2 to 3 years. And if the economy picks up steam, as my sense is it will this year, I think kitchenware and broader electricals should come through. Third one, a more recent discovery of ours is Century Plyboard. So what we are seeing is very interesting. In the plyboard sector, we're seeing a move away from unbranded to branded. So I think the move started 10 years ago, but it's really picking up steam. So Greenply is the larger name in the sector, but we reckon Century Plyboard is a well-run company, Eastern Kolkata-based company, plenty of steam left in it. But these are but 3 names in what I think is a galaxy of stocks on this entire home building theme, which I think will become a mega theme in the years to come, regardless of how the politics plays out.
On that theme, Saurabh, why don't you give us a curtain raiser on your upcoming conference in New York? Will home building be the theme, or will it be the other, what your report says, the life cycle of great companies? Can you just elaborate how you put together your guests, and therefore what do you see as other evolving great companies?
So the area we focused on was small and mid caps, because the feedback from the American clientele was that there's enough confidence vis-a-vis India now for the US investor base to focus on mid caps. To give you an example, Balkrishna Industries, it's a stock we've liked for a while, but I have to be honest, till 6 months ago, there wasn't that much liquidity in a name to be able to pull a American FII into the name. So Balkrishna continues to be a super stock, a play on European and American off-highway tires, but you can really see FII demand coming through strongly. So we've got high hopes from Balkrishna at our conference. Another example of a name which you weren't historically covering, but we are getting more and more interested in, is CESC. It's an electric utilities company. We all know the challenges with discoms, with coal, but CESC is one utility where, because of the strength of the Kolkata franchise, they continue to chuck off a lot of cash. And our hope is, if they can get the broader business, the non-utility parts of the business under sensible control, you'll see movement there on the stock price. Havells, play on electricals, on mid-cap India, another conference attendee. So that's the theme. We are sticking to small and mid-cap India, promising companies with sensible track records of capital allocation, and the American market seems to very much be interested in that theme now. Long may it continue.
Okay. Well, your report is really interesting. I mean, you talk about how great companies evolve and how you should catch them at an early stage. So as they say, catch them young and watch them grow.
Absolutely.
So in the first stage, you've identified some companies like e-Clerx, Mayur Unicotas doesn't trade much, but just tell us about these stories and how much can investors make in terms of returns over the next 2 to 3 years?
So I think one of the benefits that your viewers have that several of our clients don't is they don't have to worry about liquidity. They can buy reasonably generous sized portions of, say, a Mayur Unicotas or, say, a e-Clerx, without having to worry about, will I move the stock price if I touch the name. And the reason I like these sorts of companies is, let's take Mayur Unicotas, family-run company based in Jaipur, but the largest manufacturer by a long way of artificial leather in India. So if you drive an Indian car or if you wear Bata shoes, you'll almost by default be a Unicota's customer. It was started 15 years ago, but in the last 3-4 years, they've picked up steam. They've got contracts from Ford and GM in North America. Capital allocation has been impeccable. The family owns 60-62%, so they're highly unlikely to sort of fritter away their fortune. And what I've seen is if you buy good companies at their youth stage, what I call the early years, the first 15-20 years of their existence, you can compound at 30-35%. If you buy great companies in the youth, 30-35% compounding is what we have found in our model portfolios. If you buy the same company in its prime, when it's sort of, a kind of default participant in the indexes, in your programs, in our coverage, once it becomes a darling of the stock market, even if it continues performing well, the compounding comes down to more
then
like...
it's a done story.
I would say 20-25% compounding. And then obviously the most dangerous stage is descent. Now, one of the sort of key findings of our research is 85% of great Indian companies go on to slide. And it's almost like age in human life. As you become more and more successful and you chuck off greater and greater sums of capital, to reinvest that capital as successfully as you did before is harder and harder.
Okay, let me get to that set of companies. First of all, you're in your prime list, you have Page Industries, Motherson Sumi and CRISIL. Page Industries doesn't come on our channel at all. I mean, what I'm saying is, how do you put them all into one category? As well, Descent. You have Asian Paints, Ambuja and Apollo Tyres as Descent companies. But hasn't Asian Paints gone on from strength to strength? So aren't there companies that can defy descent?
Sure. So let me just quickly address your first point as to how do we pick a company in its prime. It's not just necessarily about size. What we are looking for is a company which is a market leader. The segment might be solved. CRISIL, for example, credit ratings, I think undoubtedly the credit rating champion in India would be CRISIL. Yes, because of the foreign owners, I think their foreign owners now own 70-odd%. The free float, unfortunately, is small. But if you wanted to find a company in its prime, the business in great shape, dominance unquestioned, great quality people, processes in good shape, ROCs 50-60%, I think CRISIL would be a name. Similarly, Page Industries, I think the Jockey franchise, almost every undergarment manufacturer I speak to, they say there's nobody close to Jockey. A lot of people have thrown in the towel and given up competing with Jockey, both in men's and ladies in a way. And hence, I think the growth runway for a Jockey is much greater than I think a lot of people understand it to be. So that's prime for me, where you're unquestioned in your dominance of your sector. Now, descent is a more interesting thing. The greatest risk, remember, to investors is when a company's dominance is unquestioned, right? So Asian Paints is so large and so dominant in paints that it's difficult to see what can they do better than what they've done, right? I'm not saying that they won't continue to excel. They've shown over the last 25 years that they're a supreme company. But what's happening is the amounts of capital that are being thrown off and the incremental capital allocation is raising questions as to will their ROCs sustain or go down. In particular, they're saying that they'll go away from paints into the broader homeware story, the story that I began with. Now, it's one thing for a small company in, say, Jaipur or Coimbatore to enter the homeware space and generate ROCs of 20-25%. But if Asian Paints with its truckloads of capital does it, then the ROCs go the other way. So this is the sort of...
So then by that argument, you can look at some of the other paint companies that have still potential to get there.
That's right. So Berger Paints is therefore not on our descent list, because Berger Paints has got that much more headroom. I think it's 1/3 the size of Asian Paints. Interestingly, Berger has kept pace with Asian Paints almost point for point on growth, but it's 1/3 the size, and hence the growth runway is greater. Asian Paints is a great company, but greatness itself poses the risk of descent in the context of our thinking. Remember, 3 years ago, we were the first in the market to put a high conviction sell on Infosys. We were so convinced that this company's greatest days are behind it. In fact, in that life cycle of Indian companies note, we've profiled Infosys through the stages. Its youth was the 90s. After the IPO in 91, 92, youth was the 90s. The prime was the noughties, right? The years from 2003 to 2009, 10. And the descent is the phase it's going through. Question mark is, can Vishal Sikka bring it into the turnaround phase?
Okay,
but actually why not other software companies? I mean, software still is India's strength. I don't notice any mid-cap software companies in your list. Are there some and not visible?
So e-Clerx, I guess, is there as a KPO. I appreciate it more a KPO than a software company. I think one of the big questions in software that we are asking ourselves is the body shopping model sustainable? I mean, one of the interesting things about, say, HCL...
But it's digital, big data, analytics.
Sure, but that is not as it's not as labor intensive as the core application development model on which India grew up with. So if you look at HCL Tech's rebirth post the acquisition of Axon, in effect what they bought was knowledge. Right? They bought C-suite connectivity through Axon and enterprise application services skills. What did Cognizant buy last week? They basically bought a platform, right? They're not buying people anymore, they're buying platforms. And I think that's the inflection point Indian IT is at. We've had 20 years where these IT companies have built up enormous reserves of cash and client connectivity basis a certain type of model built around taking bright programmers and selling their skills to the West. With Accenture and IBM as big as they are in India now, that model is not the model of the future. You still have revenues from it, but the need is now to take the revenue, make the cash that you have and invest in products, invest in knowledge so that you can then catapult to a different type of business model. I think that transition phase is underway. I have to be honest, we haven't quite figured it out as to exactly how the transition will come about, hence you don't see.
I only asked you because there's some stocks like RS Software and all which have been
which are rallying quite a bit.
2 days, 25% times.
But okay, we don't have too much time, so I'm going to squeeze in one last question. You know, you've been able to identify turnarounds or sniff turnarounds exceptionally well. Two of your big successes are TVS and Ashok Leyland. I mean, these are stocks that you've been recommending for a long time. Just tell us, are there any more companies that are on the brink of a turnaround where one can still invest into them now?
I guarantee you there are several. The only challenge is bandwidth for us to dig them out. So I think what we look for is we look for an underlying franchise which is strong, where you and I know them to be great franchises. We look for a management team which has mismanaged the situation, but which is relatively openly admitting that we screwed up. Right? And then we look for a new management team to come and say, let's conserve cash whilst we switch the business into turnaround mode. We chose Ashok Leyland and TVS with such conviction a year ago because of these three criteria. I think Bajaj Electricals still has more steam left in it. The consumer electricals franchise is well known. What I think people understand and appreciate less is that the E&P franchise is in proper turnaround mode. They hired a very good CEO a year or so ago from L&T, Rakesh Maketkar. I think he's doing a very good job of switching the E&P division from losses to profitability. And with that, I think Bajaj's whole profitability profile, Bajaj Electricals' profitability profile will change. And I have high hopes that Bajaj Electricals will be our next TVS Motors, so to speak.
All right, that's a bunch of stocks and ideas, ways to think that you have given us, Saurabh.
Thank you.
Pleasure speaking with you. Thank you very much, and have a great conference.
Of wisdom as well as to how you should approach your life. There's a mid-cycle and there's a descent, etc. Thanks so much. Have a good weekend.
Thanks a lot.